Okay, so this is the second of our videos in turning a Mod 7, giving you a little bit of background on we're just sort of the fixed exchange rate, the pros and cons. So once again, we're tailoring our discussion to this period in China when they had really basically a fixed exchange rate. Um, they allow for a little bit of fluctuation, but it was basically fixed. And the question is, well, you know, what might have been their objectives. So the first thing we want to do is we want to think about um, the differences and kind of the pros and cons. So when you think about monetary policy, having monetary policy under a flexible exchange rate system, okay, you are free to adapt to your own country conditions. So that means that you can tighten monetary policy, raise interest rates when you need to cool down the economy, when you need to bring down inflation, but you can loosen them when you need to warm up the economy, okay? Whereas if you have a fixed exchange rate system, really, you don't, if you have full capital mobility, you really don't have any monetary policy at all. And we're going to be discussing that in the next section on the impossible trinity. But the basic idea is that the country is importing the world interest rate. There's what is the linkage between the foreign interest rate and the world interest rate is very, very tight if we're assuming full capital mobility. Now, it turns out that in some cases, capital financing is not so free to move, and sometimes governments, central banks actually put some sand in the wheels to sort of prevent money financing capital from going in and going out so quickly. And if you are successful of doing that, that is to say, if your controls are autonomous, then you will that are effective, then you will get more autonomy. You will get more autonomy. The question is effectiveness. Okay, so the idea is that okay, as I'm sure that I don't need to convince you guys as business people. That when money is in sort of a higher search of a higher rate of return, or if it's the same rate of return but it's more safe, money, and you try to slam the door on those money flows, the money will find a way to get through those flows anyway, and that includes through sort of misstating in your balance of payments and sort of falsifying records. Okay, we'll be talking more about this when we talk about the impossible trinity. Now, on the other hand, it is true that many countries have adopted a fixed exchange rate as a way to keep inflation low. So the idea is that if you have your own monetary policy, you're also responsible. And that means central banks have to sort of send the signals that they are going to take the actions required to keep the inflation rate within the range, and people will have expectations about that. We've already discussed sort of the expectations augmented Phillips curve, and you know, if those expectations are not well managed, then inflation itself can be hard to control. Okay. Whereas, okay, there are cases. I think a good cases there are. For example, in Latin America, Brazil in the 1980s and even in the 1990s, and Argentina in the 1990s had inflation rates that were very, very high, and the only way that they could deal with them was by putting a fixed exchange rate system to sort of anchor expectations, and that way that this was a way for the central bank, on the one hand, to relinquish monetary policy, but on the other hand, to sort of import the low world inflation rate. But there's a warning there, is that, okay, yes, much of a country's inflation is determined from the world, and if it's passed through a fixed exchange rate, it's going to be passed through, and the country will benefit. But there's also a homegrown component. What Mankiw and others have pointed out, what we call non-tradable goods. There are some goods and some services. The prices are determined entirely in home markets, not in world markets, which means that if you heat up too much, you may get that domestic component of inflation rising, and that if you are holding the nominal exchange rate constant, that means you're going to get an appreciation of the real exchange rate. Mankiw has a discussion on that, the real exchange rate. Okay, so finally, keeping exports competitive. Now, so when you're in a flexible exchange rate system, basically you are letting the market determine the exchange rate. Okay, that's the market will set the value on your currency. Now, sometimes the market will like your currency. Market participants will be moving towards your currency, and that can be to the detriment of exporters. Exporters, they sell. Let's say in a small country, they're selling in dollars. They're bringing those dollar receipts back to the country, and they're getting pesos or yuan or baht. And the less valuable their home currency is relative to the dollars, the more they like that, because the more that they can spend, and that's actually sort of an incentive for exporters to export more. This when you have a all else equal a more depreciated exchange rate. But okay, we've been discussing that already. Then and I think Mankiw has made it very, very clear the effect of the exchange rate on exporters. Here, under a fixed exchange rate, the central bank sets the exchange rate. Now, okay, it turns out that the central bank can't set whatever exchange rate it wants. Okay, it has to sort of set a reasonable exchange rate, although once again we're going to find out that it has a little bit more leeway if it imposes capital controls. But there are some countries that have set their exchange rates to be, in some sense, biased towards exports, which means that sort of deliberately what we call undervalued. Okay, and the idea is that okay if they keep the exchange rate a little bit undervalued relative to where the market might put it, exporters will like that. That's going to boost exports. We call that the sort of the export-led growth idea that some countries have relied upon. We have to point out that this is effective only in the short run, because what will happen is that ultimately these, as we will see, this is a kind of an expansionary monetary policy. It's going to translate into higher inflation at home, and that's going to mean an increase in this homegrown inflation is going to mean an appreciation of the real exchange rate. Okay, and Mankiw has a discussion of that, of the real exchange rate, 155 to 162. Okay, now, okay, so you're going to be asking, well, okay, so what happened in China? Well, you already have some data. So you can look at that. I do also recommend maybe going, if you feel comfortable, going to, for example, Fred, the St. Louis Federal Reserve has a database. Anyway, in the next video, we'll be talking about the impossible trinity. Thank you very much.